Good morning and welcome back to the Commodities Institute podcast. I am your host, Emily Costa. It is Friday, January 23rd, 2026, and we have a packed slate of developments to unpack today. From the frozen plains of the American Midwest to the shale fields of Argentina and the copper mines of Indonesia, the global commodities landscape is shifting rapidly. We are seeing a fascinating convergence of geopolitical strategy, extreme weather patterns, and major corporate pivots that are reshaping how we think about energy and industrial resources. Let us start today with the urgent situation facing the United States power grid. An Arctic blast is sweeping across large parts of the country, driving heating demand sharply higher. At the same time, natural gas supply is tightening as cold weather freezes wells and pipelines in parts of the Midwest and Great Plains. Natural gas prices have surged dramatically in just a few days, and grid operators are warning that electricity demand could approach or even break winter records. The PJM interconnection, which serves roughly 67 million people across 13 states and Washington, D.C., is preparing for the possibility of peak demand above 130,000 megawatts for 7 consecutive days. That has never happened in winter before. The challenge here is not just cold weather. It is structural. Data centers, driven by artificial intelligence and cloud computing, now draw massive amounts of electricity around the clock. That narrows the gap between winter and summer peaks, leaving utilities with less time for maintenance and less margin for error. Regulators say the system should hold, but the warning lights are flashing and the market is paying attention. That brings us neatly into the broader energy picture, where policy and politics are reshaping capital flows. The US administration is restructuring or cancelling tens of billions of dollars in clean energy loans that were approved over the last several years. Roughly $84 billion worth of projects are being revised, with a clear pivot away from wind and solar and toward fossil fuels, nuclear power and grid infrastructure. For commodity markets, this matters deeply. It signals future demand for natural gas, uranium and critical minerals, while also influencing long-term power prices and investment decisions. Now let's move to oil, where geopolitics are once again rewriting trade flows. One of the most striking developments this week is Venezuela's quiet re-entry into global crude markets. Trading house Trafigura has sold its first cargo of Venezuelan crude under a new supply arrangement tied to Washington and Caracas. That cargo is heading to Spain, where it will be processed by Repsol, a refiner with the technical capability to handle Venezuela's extremely heavy oil. This is significant for several reasons. First, it marks one of the earliest shipments of Venezuelan oil to Europe in years. Second, it highlights the role of trading houses like Trafigura and Vitol as intermediaries, managing both the politics and the logistics of reopening flows that had been blocked for a long time. And third, it reminds us that not all barrels are created equal. Venezuelan crude is dense and challenging to refine. Only a handful of refineries, particularly in Europe, can process it efficiently. While some of this oil will move into global markets, the United States has made it clear that most of the volumes should ultimately be sold into the US system. China, meanwhile, is allowed to buy Venezuelan oil only at what Washington considers fair market prices. This is oil diplomacy in action, and it shows how supply deals today are as much about control and influence as they are about price. Staying in oil, Argentina's Vaca Muerta shale play is back in the spotlight. Shell is considering selling some or all of its assets there, potential exit that would have seemed unthinkable just a few years ago. Vaca Muerta is one of the world's largest shale resources, with enormous untapped potential. Only a small fraction has been developed, and global producers are watching closely as North American shale, especially the Permian Basin, matures. Shell's possible exit reflects a broader strategic shift. The company has been selling assets worldwide to focus on performance and returns after its renewable pivot failed to deliver expected results. Vaca Muerta is attractive, but it is also costly. Wells there are significantly more expensive to drill than in Texas, and transportation bottlenecks remain a challenge. Still, the economics are compelling, with some assets breaking even at oil prices below $50 a barrel. If Shell does sell, Expect strong interest from companies hungry for long-life shale inventory. Let's turn now to agriculture, where the mood is noticeably more cautious. In Brazil, sugarcane farmers are pulling back on investment. Sugar prices are hovering near 5-year lows, while production costs remain stubbornly high. Farmers are spending less on fertilizers and crop inputs, and some are already considering switching land to soy or corn if prices do not improve. The impact will not be immediate. The next harvest is largely set. But looking further out, reduced investment today could mean lower sugarcane processing and sugar output in the years ahead. Brazil is the world's dominant sugar producer, so even subtle shifts in planting decisions can have global consequences. Soybeans tell a similar story of expectations meeting reality. Brazilian exports in January were expected to surge on talk of an early harvest. That has not fully materialized. Harvest progress is closer to normal than many anticipated, and logistics bottlenecks are slowing shipments. At the same time, China has been buying more US soybeans after easing trade tensions with Washington. The result is a recalibration of export forecasts and a reminder that agricultural markets often move on timing as much as volume. In metals, copper continues to sit at the center of the energy transition and the artificial intelligence boom. Freeport-McMoRan reported strong earnings despite a significant production drop following a fatal accident at its Grasberg mine in Indonesia. Higher copper and gold prices more than offset the lost volumes. Looking ahead, the company expects most of Grasberg to return to operation later this year. The bigger story, though, is demand. Copper consumption is projected to rise dramatically over the coming decades, driven by electrification, defense, and data centers. That is why mergers and acquisition activity across the mining sector is heating up. Freeport, for its part, says it will focus on squeezing more production out of existing assets, particularly through leaching operations in the United States, rather than chasing big acquisitions. Downstream, copper smelters in Japan are struggling. Treatment and refining charges are under intense pressure as smelting capacity, led by China, grows faster than mined supply. Some recent deals have set these fees effectively at zero, squeezing margins to the bone. Japanese smelters are trying to differentiate themselves on traceability and environmental standards, but negotiations remain difficult. This is a classic example of how imbalance at one stage of the supply chain can create stress throughout the system. Finally, let's touch on trade and dry freight. The European Union's massive trade deal with Mercosur is likely to be applied provisionally as soon as March, even as legal and political challenges loom. Supporters see it as essential for growth and diversification away from China. Critics, particularly farmers, fear a flood of cheap agricultural imports. Provisional application would accelerate trade flows, potentially reshaping markets for beef, sugar, and grains almost overnight. On the shipping side, Jordan is back in the market for feed barley and wheat, issuing new tenders after failing to secure purchases earlier. These tenders may seem routine, but they are the lifeblood of dry freight demand, setting the rhythm for regional trade flows and freight rates. So when you step back, what do you see? You see energy systems under physical and political stress. You see oil finding new pathways through old bottlenecks. You see farmers hesitating, miners adapting, and power grids straining to keep up with a more electrified, data-driven world. Commodities are not just reacting to prices. They are responding to policy, climate, technology, and geopolitics all at once. That is what makes this space endlessly fascinating and occasionally unsettling. We will keep watching how these threads evolve, because what happens in one market rarely stays there for long. And with that, we'll wrap up today's episode. If you found this episode valuable, be sure to subscribe, share, and leave a review.